The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Alex Steele.
And I'm Bonnie Quinn. We're kicking you off to the closing bell here in the United States.
Great to have you here, Bonnie. It's been a while. Love it to have you. Especially on a day where we are seeing some market moves. So let's get a check-in here on where we stand. So the S&P is down just 0.3%. We're off the lows of the session, but it's all about the chip stocks. Bonnie was pointing this out to me in our editorial meeting. The stocks is down almost 2% off the lows, but that weighing on the broader tech sector as the rally that we saw, the attempted rally that we saw last week, really stalls out here, Bonnie.
Absolutely, Alex. As you're saying, equities rolling over, dragged down by those chips, while Scott Rubner of Goldman Sachs still sees all-time highs this week. He says demand from robots and corporates will further stoke FOMO. The Fed's unknown. San Francisco Fed President Mary Daly says adjusting policy is appropriate to prevent hurting the labor market. The pace of cuts, though, still unknown. And prices rally for oil as eastern Libya says it will shut down oil production and exports amid already heightened tension between Israel and Hezbollah. Energy equities outperform.
The S&P closing within 0.6 of an all-time high last week, really pairing almost all of that 8.5% drop. You can just really see that drawdown that we saw in early August and how we've come back from that and almost really at neutral. And the question really becomes, what happens this week? We have a market event within Nvidia. We also have the PCE, and then we have Jobs Friday in about a week and a half time. And does that kind of change the calculus, or have we just kind of forgotten the last 4 weeks in the market, Bonnie?
Well, I think that I would bet on it's going to change the calculus, because what hasn't over the last several weeks this year, Alex? Well, let's kick things off now and get Mo Haghbin to answer this question, Global Head of Investment Solutions with Invesco. Mo, thank you so much for joining. So let me ask you that. I mean, is this particularly something that has a catalyst today, the sell-off in semis, or are we just treading water given that we're in thin liquidity days?
Sure. Well, thanks for having me. It's nice to be back in studio with you all. Look, I think that this week is going to be an important week. We have the earnings report, the AI theme, whether that's going to continue to extend and show kind of resilience. We also have jobless claims and, as you mentioned, core inflation, which, PCE is the preferred measure for the Fed. So I think, what's going to be interesting is more on the job side than on the inflation side. To be honest with you, I think the Fed has pivoted away from inflation, rightly so, because if you look at year-over-year inflation and even quarter-over-quarter inflation, you're getting closer to that 2% target. So what I'd be really concerned about and really watching closely this week is around jobs, and are we seeing that unemployment rate tick up as we've seen in the last couple of quarters?
Before we get to jobs, we have Nvidia. We're going to talk about that throughout the next couple hours, and I'm obsessed with it, whether it's going to be a market event or an Nvidia event. And if it's just an Nvidia event, can the S&P continue to kind of grind its way higher without the semis?
Well, I think AI and Nvidia is a market event, just given how significant the market capitalization is today, right? So in a way, your view on Nvidia is a macro bet, because a lot of the market return year to date and the volatility of the market year to date is coming from that sector and that stock. So absolutely something to be watching carefully. I think longer term, really the question is the unemployment and employment rate in the U.S. starting to tick up? And what we've usually seen with unemployment is as it starts to tick up, it doesn't go back down, right? So where we've been a bit more cautious and defensive in the portfolio is really around what we're seeing in the labor market.
Well, so we just spoke to Mary Daly, our own Michael McKee, speaking with the San Francisco Fed president, and they watch the labor market very closely. They talk to smaller businesses around the San Francisco area, and she said she doesn't see any real weakness in the labor market. Did you find that comment interesting?
I think it is interesting. It really depends on how you look at it, and there is a supply related issue here that I think is built into some of the reporting and some of the numbers we're seeing. But it's hard to deny that we're seeing a softening economy, and it's hard to deny that we're seeing a softening jobs market as well. So to me, it's really, to your earlier comments, what is the path for rates, not whether or not rates are coming down. And that's really the focus, and has been the focus over the last week.
That's why there was a head scratcher, because, the Russell's outperforming today, up 0.3%. I would not have expected that. If we're worried about growth, we're worried about the dollar being on one side of the smile, which is more of a safe haven bid versus like an outperformance of the U.S. bid. I don't get it.
Yeah, Alex, you're asking actually a really interesting question, because what we're seeing is the relationship between rates and equity sectors start to break apart a little bit. What used to be the case is when rates went up, that was generally a bad thing for defensive sectors, right? Because they have more interest rate sensitivity, they have bigger cash flows that are further out into the future, and you have to discount those cash flows to today. We're seeing the exact opposite. So when rates are going up, it's not a bad thing for tech. And when rates are going down, it's actually been a good thing for small caps. So it's a very interesting relationship between rates and equity sectors, which has historically been actually not what we've seen in quite some time.
I mean, when we do get this first cut, will it not be good for all equities? What is the trade when that happens?
It's a good question. And I think what's going to be important is, what is the cut? Is it 25 basis points or is it 50 basis points? I think if it's 50 basis points, that's probably not good for equities because it's confirming what we're seeing in the data, which is the jobs market and growth are challenged. If it's a 25 basis point cut, I do actually expect that to be positive for markets because that indicates the Fed is not that concerned and it's a slow and gradual renormalization of rates over some time.
But to Tony's point, if the Fed cuts not in a recession and they're cutting to normalize, doesn't that change the rotation of what you'd normally expect in a rate cutting cycle? Or not?
It does. I think where we would be positioned in this current environment, and I'm happy to talk a little bit more about this, is more on the defensive side. So we tend to like larger capitalization, larger companies, both in the U.S. and abroad. And we do have a bit more of a home country bias because our view is that softening data is what's leading the Fed to cut. And therefore, there's probably a little bit more defensive posture required in the portfolio. And look, I've been on with you all before over the last several quarters, and I've been very pro-risk assets for a very long time, pretty much since COVID. This is the first time last month was the first time we started to cut equities back, and we're actually underweight equities versus our benchmark. So that tells you a little bit about how we're thinking about the current economic environment.
It is a slower week, right? We're in the last week of August, and even though there are plenty of catalysts this week, there'll be labor data at the end of the week and also a lot of consumer data this week as well. Will the market's attitude change post-Labor Day?
Well, you have some important stuff happening in that first week or two of September. I mean, the one big event is really the jobs numbers on September 6th. I do think that the market is much more reactive to data right now than it's been in a long time because equities have been stretched and risk assets have been on a pretty nice run. I mean, the S&P is up 18% year to date. Corporate credit spreads are extremely tight. Actually, what you mentioned earlier, all of that underperformance or that drawdown in equity markets and the credit markets have completely reversed. We're back to all-time tights in credit. We're back to all-time highs in equities. So I think the market will be much more reactive to the jobs number. And if it's a bad print, I do expect volatility to pick up.
So you're cutting risk appetite after being risk on since COVID. Okay, that's a pretty impressive statement. Are you cutting risk appetite to go pure defensive, like I'm going to put gold under my bed kind of thing?
No.
And just go buy gold? Or is it just like, you know what, we got some nice runs, let's just have some staying power here?
It's the latter.
Okay.
And our underweight in equities, in most cases, it's really like 5% relative to our benchmark. So what we're not expecting is a recession in the next few quarters. And I don't think we've ever experienced a recession with labor markets being so strong. I mean, we've seen some weakness, but let's just be clear. The average unemployment rate for the U.S. over the long term is well north of 5%. We're at 4%. So in the grand scheme of things, it's a very strong labor market with signs of some weakness more recently.
And Mary Daly, to that point, also used the phrase highly restrictive. She says this is a highly restrictive monetary environment, which I found interesting. What is the outlook for the consumer? We continue to see very mixed retail reports. We're going to get more consumer confidence data tomorrow. And remember, last time it performed better than expected, but people were worried about the labor market.
Yeah, so we don't see any major excesses building up for the consumer. There's not like over leverage in the system. What is interesting, though, is the savings rate has gone down. So if you look at the savings rate, we're kind of back in the 2008, 2009 level, which sounds a little scary, but I don't think it's that bad. We had a lot of spending happening post-COVID. The government basically shut the economy down. We reopened the economy. Everybody went out and spent. And by the way, there was a huge amount of stimulus provided to the market to go and spend. We're starting to see some of that tail off, and I think that's only natural. The consumer, though, doesn't scare me at the moment. And of course, the U.S. being such a reliant economy on consumer spending, that would be one of the areas we'd want to watch carefully.
Yeah.
But to my earlier point, not likely that we're going to have a recession in the next several quarters. The probability of a recession, though, has gone up versus the beginning of the year, and I think that's really informing our defensive posture in the portfolio.
You have to wonder if the election as well will change all of this come October, November.
No, that's a whole different segment.
Mo, thank you so much for joining us. Mo Haghbin, Global Head of Investment Solutions with Invesco.
All right, coming up, Brent crude oil contracts bubbling higher now as issues in the Middle East intensify the oil trade, where WTI and Brent could be headed by the end of 2024.
Plus, shares of Planet Fitness getting a cardio boost today, while Baird is maintaining its outperform rating and a $92 price target on the stock.
I like that. I like that cardio thing. All right,
Yeah.
Shares of Boeing now cruising for a bruise and down 30% so far this year, while even more bad news is sending the stock further down today. All that and more coming up on the close on Bloomberg.
It is incumbent on all parties in the region to work towards de-escalation and stability. And so we are feverishly working in Cairo as we speak with our team and the teams of the other mediators, as well as with the Israelis, to get to a ceasefire and hostage deal.
That was Jake Sullivan, U.S. National Security Advisor, speaking yesterday on the Israel-Lebanon attack. And this is just one issue now moving the oil market today. Libya's eastern government saying it will shut down crude output and exports in a new round of conflict within the country. Joining us now is Bloomberg's Devika Kumar joining us. Devika, the big question is, in terms of Libya, how long does that shutdown last? And does that shutdown spread?
You're asking the million-dollar question that all traders are looking for the answer. And, you know, if past outages are anything to go by, Libyan outages do get solved fairly quickly, maybe in a matter of a few days. But it does tend to have ripple effects across the market. Now, interestingly, this time around, the main Libyan oil field, the Sharara oil field, which produces about 270,000 barrels a day, has actually been shut since early August. And if you really want to get a sense of how oil markets are underlying under all the geopolitical tensions, you can see it by the fact that the market barely reacted to that news for the past month or so. So now you're getting the risk that almost 1 million barrels a day will now be affected. And that's what we're now seeing this reaction for.
Devika, Libya is responsible for about 4%, right? Iran, Saudi Arabia, they're all above 30%. What's the maximum kind of impact that this could have, even if we're a total shutout for a long time?
Yeah, it really comes back to that question of exactly how long. We're coming into the time of year in oil markets where things start to slow down a little bit. We're past the peak demand of summer driving season. We start to see some of the refineries go into maintenance to conduct, operational work. And now the question is how long the outage lasts. Now, if we start to see demand pick back up and unexpectedly see some more supply outages, this could easily send oil into the mid to late 80s. Now, this is going to be an interesting question coming up for OPEC as well, and whether or not they're going to bring back some of the barrels the second half of the year as they were planning to.
Well, that was one of my questions, Devika, is I was wondering if OPEC Plus could then see this, and I realize that Libya is part of OPEC, could see it as an opportunity to finally get their oil back online if that outage continues. I mean, there's such a large spare capacity. I have a hard time believing we're going to get into the 90s and stay there.
Yeah, exactly. It's like we've been stuck in this range, and now it's almost like a repricing of that range. The question then becomes what happens with demand, because there's obviously some signs of softness from China and the US. You guys were just talking about this. We're starting to see signs of softness, inflation cool off a little bit, and energy was a big part of that, remember. And gasoline prices have actually come off and are sitting at the lowest in 6 months, which is then going to create almost like you're going to have to back into the policy a little bit, kind of work your way back from how demand is looking. And then OPEC is going to have to take a view on the overarching state of the market.
Devika, you said these particular problems in Libya tend to get solved pretty quickly. But here you have militias and a government. You have Russia supporting the militias. You have Turkey supporting the government. Who wants a solution to this?
Honestly, the market is very keen to see this resolved pretty quickly because, like I said, what the market doesn't like is uncertainty. And at this point, there's just no clarity in terms of how long this is going to last or if this is going to escalate further. And add to that the backdrop of Israel and Lebanon, you have a market that is very on edge. And even if the underlying fundamentals state that oil markets are not so bullish, traders don't really have the conviction to take on that short position because there's a risk that we have developments like this over the course of a weekend, and then you're going to come into an oil market that's up 3, 4, 5%. And that's just not a risk traders are willing to take.
Quick question before you let you go, Devika. What's positioning like right now?
We're pretty bearish, and which kind of gives traders the belief that given positioning is so bearish, especially across the speculative and the money manager side of things, that we could actually see a little bit more of a pickup as traders unwind those positions. But they're going to need a lot more catalyst to break out of that bearish mentality that it's set in coming into this weekend.
Devika, thank you so much for your time today. Much appreciated. That is Bloomberg's Devika Kumar. Difficult time to be a central banker in Libya.
Oh, yeah. I would say so, for sure. Also, it's interesting. Libya has this light sweet crude, right? So I wonder if we're going to see it in differentials instead of the overall price. I wonder if that's going to be a little bit more beyond the surface. All right, coming up, you got Baird getting pumped up over Planet Fitness stock. We're going to tell you why in our Top Call segment. That is ahead. This is The Close on Bloomberg. All right, time now for some of our top calls. A look at some of the big movers on the back of analyst recommendations. And we're going with a bit of a fitness theme today, guys. First up, Foot Locker. Baird kicking its price target up to $35 from $26 while sticking with a neutral rating on those shares. The firm anticipating relatively in-line results when retailer reports on Wednesday, but seeing several potential headwinds for profit upside. Those shares up about 1%. Next in line, Nike. Stifel just doing it, lowering its price target on the shares from 79 to 88, but sticking with their hold rating. Now, the analyst says Nike is facing broad-based competitive pressures as evidenced by their back-to-school athletic footwear survey, adding that the company has already lost a meaningful chunk of U.S. footwear market. Shares just up by about 0.2%. And finally, Planet Fitness. Baird raising the bar, naming it bullish, fresh pick through the end of the year. They are excited by the gym operator's strong consumer value proposition and high-margin franchise model, which should prove resilient in a challenging macro backdrop. Shares are up by 1.4%. And those are some of your top calls. Bonnie?
And Alex, we're going to go back to that last call there on Planet Fitness and bring in the analyst behind it. Jonathan Kemp is Senior Research Analyst over at Baird, and he joins us now. Jonathan, thank you so much. So, Jonathan, one of the reasons why you have upgraded your price target and so on is this new CEO, Colleen Keating, right? What should her strategy be? Attract more franchisees or something else?
Yeah, Vonnie and Alex, thank you for having me. That's right. So Planet, as you know, is the leader in the gym industry with almost 20 million members. Very strong franchise model. If you look over the last year, though, this has really been a story in transition. Part of that's been leadership change. They replaced the CEO. Just recently, Colleen Keating came in as the new CEO. She's going to be making a few additional hires as we go along here. But we think over the last year, there's already been a lot of heavy lifting in terms of efforts to strengthen the returns on building a new Planet Fitness for franchisees, and going forward, commitment to really look at things like marketing and the member experience to continue to make upgrades that we think going into next year can really be a big driver.
Who's a straight up competitor to Planet Fitness at this point? Because they're so basic and so inexpensive, yet they have so much volume. Like, who's a good thought of competitor here?
Well, Planet's really been a disruptor, a long-time disruptor in the industry. They really largely scaled and created the low-cost model, and that's attracted a lot of members. In terms of the public company landscape, there really isn't any other competitors today in the U.S. Some of the competitors are in the private sector, much smaller than Planet Fitness today. And that's where we think Planet has a pretty big scale advantage. They spend more than $300 million of marketing every year across the system. And that's some of the reason why we think there's big upside opportunity if new leadership can really get it right in terms of marketing and messaging and utilizing their scale to their advantage.
You know, it's funny, Alex and Jonathan, I looked this up beforehand because I was curious too, right? So the RV function on the Bloomberg, you can see, and it said things like Soho House and Time Life Group. And so they are not competitors in the daily world. They might be on some metrics.
Oh, definitely not.
Yeah, so it's really actually hard to find somebody that will allow you go every day for like $15 plus an annual fee plus an initiation, which are all under $50. So Jonathan, what happens when interest rates go down? Does it make buying real estate, more attractive for Planet Fitness or for franchisees? Do they rent for the most part? How does that impact things?
Yeah, there's a couple of factors. So we think as a result or related to a lower interest rate environment or a falling interest rate environment, really ties hand in hand with also some slowdown in the economy. We certainly see that in our research and the data related to consumer spending and employment. I think some of your earlier guests highlighted as well. And our thought is the value proposition is so strong for Planet Fitness that we don't expect a major impact to the company's fundamentals or the revenue growth. What we do expect is the incremental cost to build a unit, whether that's to finance through interest rates or even the cost of construction. Both of those areas we think can get relief into 2025. And then on top of that, and maybe as a result, if you look at Planet's stock price, we've noted a pretty strong inverse correlation to interest rates. So when interest rates are falling, that's tended to be pretty positive for the stock, and that's what we're looking for into 2025. We think there's some real tangible benefits, but also maybe sentiment tailwinds as well if we see lower rates into next year.
I mean, the stock has had quite a run. It's at a 52-week high today. It's been super solid. And then obviously based on your upgrade today, the stock is slightly up as well. I guess I wonder sort of how much more juice short term can we expect from the stock?
Yeah, we've been positive. We've had an outperform rating and favorable price target. That's really on a 12-month basis. Our call today is adding an extra conviction level in terms of the short-term trading setup. And that, again, is getting ahead of what we see as a better setup into 2025. We did outline a bull case of north of 100, so even above where we have our stated price target based on the fundamental backdrop we see. But we think there's still a lot of room to run. I realize the stock is pushing a new 52-week high here. If you actually look back to early 2023, when the stock was last around these levels, the earnings are actually 30% higher than they were back then. So I would argue on a price to earnings or other valuation metrics, the stock still looks relatively inexpensive, and it's trading below where we think it should relative to the franchise group peer set. So that's where we see opportunity in addition to the fundamental growth outlook.
Hey, Jonathan, really appreciate it. Thank you so much, Jonathan Kemp of Baird, joining us. I used to go to Planet Fitness, pay like $10 to go for the day.
Yeah.
Super awesome. All right, coming up, Principal CEO Kamal Bhatia weighs in on the pacing of the interest rate cycle as Powell opens the doors to cuts. The pace, though, still in question. This is The Close on Bloomberg. It is just about 3:30 in New York. This is the countdown to the close, half an hour away from the closing bell, and stocks, particularly tech, trading a little bit heavy. I'm Alex Steele.
And I'm Bonnie Quinn.
Well, we heard earlier today from Mary Daly, the San Francisco Fed president. She spoke with Michael McKee on how she sees the rate path cut evolving.
Well, to my mind, we've been on this path of ready to adjust policy rates for several months. We just needed to get a little more confidence that inflation was truly on its path to 2%. And I wanted to see the labor market come into balance, but I think that's completely happened. And the risks to our goals are now balanced, and the time to adjust policy is upon us.
All right, let's get some more reaction here from Kamal Bhatia, President and CEO of Principal Asset Management. Kamal, great to see you. Thanks for coming into the studio.
Good to see you.
So it's very clear. The Fed's going to cut in September. How much they're going to cut and how quickly after that they're going to cut is the question. How do you guys think about it?
Yeah, so I think, as you heard Mary Daly say, I think they have much more confidence in their path forward than they've had in the last few months. I think the big change for them is just they feel more confident about inflation. I think their eye is on the labor market now, but even the labor market dynamics are giving them comfort that the labor market has weakened. Our view is a little bit that it's the supply of labor coming into the marketplace rather than unemployment, which is, I think, giving them a higher confidence on the path forward. So clearly, September is in the books, and they just have to see how the August job report looks.
It's a little concerning, though, Kamal, right? Because it's going to be either 25 or 50. It's more likely to be 25, but it's a massive difference, especially for the first rate cut. How are you hedging for a potential 50 basis point cut?
So that's a great question. So I think this rate environment has not just us, but every global investor paying attention to the path forward. Our view remains that it is valuable. The 25 basis points is much more valuable to fixed income investors than equity investors. I think you need the rates to move by 50, 75 basis points for the equity and the real estate investors to really care about that move. Given how long portfolios are from a duration perspective, any rate cut is going to create value for the fixed income investor first, and that's how we think about it.
So we've had a nice little washout here in the summer months, right? What's working right now in this environment and in this market?
I would say quality has come back into vogue. We've had few years of very, very strong momentum on the equity side, particularly with the tech names. But I think quality is really coming back. I would say the sweet spot of the marketplace seems to be also mid-caps, to some extent some smaller caps, but mid-cap really is an area where you see rotation happening and a lot of earnings getting more attention. So I would say that from a risk perspective is in vogue right now.
You're big real estate investors?
Yes, we are.
We're all waiting to see what the impact on real estate will be, right?
Yes.
From mortgages to new builds to
Yes.
everything else. How hurt was your REIT franchise, and what do you anticipate will happen between now and the end of the year if, there are indeed 4 cuts?
So REITs were depressed. They were much more depressed than
They
we
were
have
very
seen.
sad, yes. They cried a lot.
For many years. But if you look at year-to-date returns, almost all REITs, including office REITs, which were the most depressed, have rallied very, very quickly. I do think there is more to go on the REIT side. The area that we see most momentum on is, obviously, we are a big investor in data centers, but we also do hotels and industrials as well. I do think as the market evolves in REITs, I think the global REIT portfolio has still not corrected as much as we would like. I think partly because of what happened with rates in places like Hong Kong and Japan, in addition to the US. But I do think the housing side of REITs is probably going to react very, very well. Industrials and housing would be an area I would watch out for.
But this is where the 25 or 50 comes into play, right?
Yes.
If it's 25, that's a normalization, in
Yes.
which case, okay, that's probably good for REITs and it's good for small and mid-cap stocks. But if it's 50,
Yes.
that says to me we're in deeper trouble than we thought. And then that's not so great for SMID. Or maybe it's a little dicier when it comes to real estate. Is that fair, or am I off?
I think 50 basis points still is good for the markets. It's not, we've been at such high elevated levels of rate that a 50 basis point cut is not really going to be a signal of a damaged economy. It's really just creating more opportunity for debt investors to get back into the marketplace.
You said you're in hotels as well and around the world.
Yeah.
Obviously, there are some parts of the world that are hurting very badly, and we're getting more and more confirmation that China is one of those.
Yeah.
But, even in the US, it's a mixed picture about the consumer. We're not quite sure how healthy the consumer is at the various levels. Can you tell us a little bit more about that?
So I think the biggest change in that sector has been supply is the bigger story than demand. I think across the world, and we've all seen this with how the consumer has behaved, an extremely strong consumer that has continued to spend. You've seen recently luxury and leisure take a back seat. You particularly heard it from the airlines and some of the other hospitality operators. But there is generally a dearth of supply of hotels across the world. And strategically, we are much more of a strategic investor. I do see in places like Europe, that is something where demand supply has been an imbalance for a while. In US and in Europe, I would say data centers, which is a big AI play, continues to be very, very strong in terms of pickup on cap rates, as well as how occupancy or use by a technology company scales up.
So for your clients, what do you tell them about how to deal with AI in terms of how to invest at this point, if they weren't already invested?
Our view is you want to invest in the infrastructure of AI.
Okay.
And I think you've seen it with the hardware companies, but the real estate companies are a big participant in the build out of the infrastructure. And I think that is the way to play it in our view, because that is a very long tail cycle that will take a while.
So why did we see the siphoning off of Nvidia in this market sell-off, right? So Nvidia is still doing fine. It's doing better. And all of the other AI stocks seem to be selling off still.
Well, it's an amazing technology company, but it has had a lot of interest and a lot of momentum. And so longer term, it'll still do fine. But as I said, there are other sectors attached to AI that are catching up now. And I think you'll get to a balance in who participates in this growth cycle.
Then isn't there so much demand in that? I mean, I feel like I talk to every real estate guy and they're like, data centers, yay.
Yeah.
So like, isn't that driving up valuations and going to sort of squeeze then potential returns or what?
There has been a lot of interest in the sector per se. We've done this for a long time, and I think our view remains that you need to be an astute real estate investor to really operate. Ultimately, it is real estate. It is not technology. And so you have to have been a long-term real estate investor. You know, our company's been in existence 145 years, so we've done real estate for a very, very long period of time, including GFC. One of our views is you have to understand how to manage the property. You will have to have an understanding of how you build these assets and how you maintain these assets. And there is a big element of getting the right power supply, managing water. So it's a more complicated real asset type than most people realize.
Well, we can't wait to have you back for an update after the cutting cycle starts. Thank you to Kamal Bhatia. He's president and CEO of Principal Asset Management. Coming up, Boeing just can't seem to catch a break. Shares fall after the aerospace company's latest space mission has to be rescued by SpaceX. What it all means for the future of Boeing's space program. It's today's Stock of the Hour, up next on The Close on Bloomberg. We're keeping an eye on shares of Boeing after NASA announced SpaceX will use one of its capsules to bring home astronauts stuck on the International Space Station next year. This after the Boeing-made Starliner that sent the astronauts up there suffered, malfunctions. Bloomberg's Abigail Doolittle joins us with what this means for an already embattled company. It's a pretty big statement when you say, yeah, you put them up there, but look, it's broken. We're not letting you back up there.
It's not good at all. I mean, this is a really interesting story. We have a lot going on with space right now, especially with Polaris tomorrow. SpaceX's first commercialized spacewalk flight, which will be pretty exciting. But so these two astronauts have been up there since June. It was supposed to be an 8-day flight, but apparently there was some helium leak problem that they've been testing ever since. And based on everything that I've read and the conversations that I've had, it's not clear to me that if Boeing was making the decision on their own, that they would necessarily choose to use SpaceX. It sounds as though NASA's really making the decision that they want these astronauts to be safe, and so they're going to use SpaceX. They have two different suppliers for their capsules to space. It's both SpaceX and Boeing. You know, it's interesting. So Boeing just cannot catch a break. Bad headline after bad headline in terms of their planes and the different parts there. You know, at the end of the day, this is, a rounding error in terms of their bottom line. But reputationally, here we have yet another Boeing problem. And now it's not just airplanes, it's spacecraft.
Yeah, I was trying to figure out like how much they wind up spending on space and if the new CEO is going to continue that. And to your point, it's wrapped into that defense and security, right? So that revenue is $6 billion. I was looking at this for the second quarter. The R&D expenses are $555 million, and operational income was a negative $913 million. But I don't know what is space and how that winds up shaking out.
So not only should you become the CEO of the company that we were talking about last week,
definitely not.
Now become an analyst here the way you're thinking through the. I mean, so it's really interesting. We're going to have to wait on CEO Kelly Ortberg to see how interested he is in pursuing this. I think it also is going to have a lot to do with this capsule. Will it be able to return, come back to re-enter Earth back into our atmosphere autonomously and safely? If it does, then you have to believe that NASA is going to continue to work with them. Although NASA is saying that they may have to test this particular capsule a number of times. That would cost another $400 million. I think we just don't know right now. You know, Elon Musk, CEO of Tesla and SpaceX. He had a really interesting tweet basically saying that in the same way that cars were never meant to make aircraft, or automakers were never supposed to make aircraft, that aircraft makers are never supposed to make spacecraft. So he's really making the point that a spacecraft company has to be the maker of spacecraft. spacecraft. Whether or not that will prove true, we're going to see. You know, Kelly Ortberg, in terms of Boeing, this
and
is
yet he makes cars and tunnels.
Good point. Well, I guess he's the ultimate Renaissance being, I should say. You know, Renaissance man. Lots of different businesses there. But there does seem to be this little bit of a tension between Boeing and SpaceX. Some of what I read, Boeing folks are really unhappy that SpaceX is coming up to rescue those astronauts.
Yeah, it doesn't look very good on the surface there.
Optics not great.
All right, Abigail, thanks a lot. Really appreciate it. Abigail Doolittle joining us there. One other stock we're watching here, if you look at the ADRs, is PDD Holdings. Shares fell the most since about 2022. So this is Temu's owner, and warned that revenue growth will inevitably dwindle. That is a terrible statement from your CEO. Have you ever been on Temu here in the US?
I actually have. Yeah.
Yes, me too.
I can't bring myself to shop from them, but you know, it was only founded in Boston literally 2 years ago. Can you believe that?
Same. I've browsed it and haven't bought anything, but apparently it's the most downloaded US app. Has quickly become one of the most downloaded U.S. apps after it debuted in 2022. But apparently, if you have razor-thin margins and the consumer's kind of rolling over, that's a really tough place to be.
Exactly. But remember when Yahoo was saved by its ownership of Alibaba? You have to wonder how some other company like PDD can do the same thing as Alibaba and be competing with Alibaba in such a short period of time. Even PDD was only formed in 2015.
Yeah, it's such a good point. And also that quote from the co-founder: high revenue growth not sustainable, a downward trend in profitability inevitable. That's not great.
So great.
You don't want to see that. We don't want to hear that.
Not great for the Chinese consumer either.
Exactly. All right, well, coming up, Kimberly Forrest, founder and co-investment officer at Bokeh Capital Partners, takes us into the close. We're about 15 minutes away on this Monday. This is the close on Bloomberg. We're about 10 minutes away from the close of trading on this Monday. Bonnie Quinn alongside, I'm Alex Steele, that's Bonnie Quinn. She's alongside me here.
And I am alongside
and yours, it counts. Looking at the market here, we are bouncing along the bottom for the S&P, for the Nasdaq. The stocks, though, continue to roll over, now down by 2.5%. The Russell holding up, but now just barely.
Well, it's interesting because you're never really supposed to take any signals from a Monday, and yet you just can't help it, right? I mean, this is such a major signal. And yes, we do have Nvidia Wednesday and so on, but can't help but taking this seriously, even if it is thin liquidity.
Yeah, exactly. Good point. And Bloomberg Intelligence had their note out, their morning note, saying that last week's moves appeared with the lowest volume week of the year. And I wonder if this is going to parallel it, and then what does that wind up meaning for Nvidia when we get those numbers on Wednesday?
Exactly. 4:20 Wednesday, tune in because you'll be covering them.
Oh, I'll be off. That's up to Scarlett and Maine. Oh, yeah. No, that's all on them now.
She'll be spending her profits from Nvidia.
No, I wish that was true. All right, let's get more insight into this with Kim Forrest, founder and chief investment officer over at Bokeh Capital Partners, formerly sort of an IT nerd herself. Kim, what do you expect from Nvidia, and sort of how do you play Wednesday?
Sure. Well, here's the deal. Absolutely no one has given any indication that they're not continuing spending. In fact, Google, Amazon, Microsoft, they all said they're going to spend more on this. So I don't really understand what the spook is here, kind of like when you're riding a horse and it just shifts 4 feet to one side for no reason. That's what the market's doing here. But I do think maybe investors are looking and going, hey, it's been a great almost 9 months of the year. Let's take some profits. And I never, ever say that. But I think Nvidia is the key to this. And people are worried that they're not going to have forward projections that are high enough to sustain its price right here.
Well, it's really very difficult to value a company like this, right, Kimberly? I mean, we have been seeing price discovery ongoing now for several quarters. Right. I remember when analysts were upgrading to, the $900 mark and everyone was gasping, and then suddenly we had the split, and now we can be at 150. We were at 150 just a little while ago. So when does this price discovery process for all of the chips, when does it sort of come to rest?
I'm going to be honest with you. I don't know, but I know the conditions under which it needs to come to rest. And there are a couple of moving parts. First, there's AI, and are we going to need many large models? I think the answer is no, but I think it's still going to consume a lot of the high-end chips. And these, do you notice I don't put numbers with them? Because I don't think anybody knows the numbers. So there's that. The second thing, and I was on talking with a friend about this, tech used to go up and down and kind of be the indicator of the health of the economy. And I think that was because whenever back in the 90s and early, in this century, when people were hired, companies had to buy them a PC. They had to buy them additional capacity for the network, and all this stuff had to be added. And that doesn't really seem to be going on now. We're not adding tremendous amounts of people, so we don't get that lift whenever hiring happens. And I think people who watch semiconductors are overreacting to maybe slower economic news, thinking that, just like in the old days when people got laid off, nobody bought new PCs. But that is not the driver behind semis now. And I think investors have to wake up to this new world and understand it, and not sell off whenever you think the Fed is lowering because, it sees trouble ahead.
Oh my gosh, does this say that you're avoiding the macro? Is that what I'm hearing, Kim?
No, I'm paying close attention to the macro, but I think other investors are using the old rules.
Using the old rule of what?
Of, good times means that companies buy more technology. And I don't know that that's true. I think companies buy technology now to get better productivity, not necessarily to roll out a whole fleet of new PCs for their people.
Is there just a lot of exuberance in Nvidia, though, Kimberly? Because if you look at the sell-off recently, Nvidia has recovered a bit. I mean, not all of its losses, but many of the other associated Halo-type stocks haven't.
Right. Well, I think that's because nobody really understands this world, and they're trying to play what they know. Again, a lot of retail money moved into Nvidia since the split because they thought it was cheap. Whether it's cheap or not, we'll see. But the fact is that I don't think anyone really understood how much that extra buying from retail pushed the stock so tremendously high. And then when that dried up, the support wasn't there. So new rules, same stock.
Okay, what's your top pick right now, Kim?
Well, this might elicit an eye roll, but I really love AMD. This merger that they're doing, or acquisition that they're doing with a company that essentially helps the AI chips get on a board and get out into the real world, is going to allow them to better understand their true end client, which is the Microsofts, Googles, and Amazons of the world. They're going to have 1,000 engineers, and that's 1,000 more engineers that Nvidia does not have for how these things have to act in the real world. I think it's a brilliant move by Lisa Su.
And the stock is only up 1.8% so far this year, even though we have had a big run up. Have you given up on Intel, Kim?
Not really. I just think it's been stretched out in time. So I think that they still have a lot of technology in-house that needs to somehow get recognized and, come back into play. But it's not the top pick right now because of the timeline has been extended.
Do you think, Kim, that you're going to learn anything about retail this week, though, if we just move for a second off of tech? We have Nordstrom's, we have the dollar stores, we have consumer data, et cetera. What are you going to learn?
I think we're going to learn what we've been learning all earnings season, is that if the consumer wants to buy something, they'll find a way to do it. And if it's just a meh kind of product, they won't. And it looks like Kohl's just was so punished, but TJ Maxx looks like the best place on earth to shop. And they serve the same client. They just don't serve the same product.
Yeah, I think Kim and I have been trying to get a little journey to TJ Maxx.
You love TJ Maxx, am I right?
I love it. Yes, good memory. Kim, you don't like it? You eye roll?
I love it.
You love it? Okay.
Of course I do.
Who doesn't love TJ Maxx? They get new things every single day.
Yeah, I know. All right, Kim, thanks a lot. Kim Forrest, founder and chief investment officer of Bokeh Capital Partners. Appreciate that. Thanks a lot. You know who doesn't like it? Romaine. He gets lost in TJ Maxx. I mean, what can I say? Yeah.
Romaine is a little bit more,
He's a super high end. He's a super high end consumer. All right, we're just about 3 minutes away from the closing bell right here in the U.S. And we're counting you down to that closing bell. We get full market coverage right here on Bloomberg Television.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Alex Steele and Bonnie Quinn here to help us take us through the Closing Bell, a global simulcast. Scarlett Fu, Romain Bostic, and Carol Massar all off today. Maybe they're all vacationing together, but Tim Senevic is here, joined by Katie Greifeld, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the day.
If they're all vacationing together,
Tim and I, we did not get that memo.
Yeah, if they didn't invite us, that would be not cool, right?
Super not cool.
No.
But Katie and Bonnie, we are very happy to have you here. I'm looking at the market, guys, here. Yes, tech is trading heavy, really led down by the chips. But again, that light volume, and you have to wonder how much you can take these moves seriously as we head into Nvidia on Wednesday.
Okay, yeah, you bring up everything that I want to talk about. Look at this, 25% lower in volume for the S&P 500. Nasdaq Composite down slightly. We're seeing mega cap tech under pressure. But again, we're post-Jackson Hole, so really the highlight of this week is what happens just after 4 o'clock, Katie, on Wednesday the 28th when we hear from Nvidia and Jensen Huang.
Oh, yeah, big time. And it's interesting to see Nvidia take a little bit of a bath today, down 2% or so. But of course, all that event risk coming on Wednesday. You think about what's priced in terms of the one-day move for Nvidia, and then what's priced in for the S&P 500. Some are saying this is as important as a Fed meeting.
Well, speaking of the Fed meeting, even though Nvidia is probably the biggest event of the week, we also get a lot of economic data, including consumer confidence, which sort of threw us crossways a little bit the last time it came out. Also, durable goods orders today, which came out very strong, although not non-defense ex-air. That was a little weaker than expected. But there's a lot of data, including personal income and spending later in the week.
It's such a good point. And we also have gold at a record. So clearly there's a safe haven bid, whether or not that's earnings related or geopolitics related or economic data related. All right, there you have the closing bells on this Monday. Volume really weak. You have the Nasdaq closing down by about 0.8%, the S&P down 0.3, the Dow Jones up by about 0.1%. We're still settling out, but a kind of mixed day to the meh side, Tim.
Yeah, but it just does go to show what did move higher and what did move lower in the S&P 500. When you do see that more stocks were higher in the S&P, even though we moved lower as an index. 270 stocks did move higher today. 231 stocks, Vonnie, did move lower.
Well, and exactly, if you look at the segmentation of the market, right, there's a lot of red there, but it's essentially a lot of IT and semi stocks, industrials, consumer discretionary, for example. And there are 4 or 5 areas that are higher. Mostly, though, it's energy. It's those energy producers, which we're going to be talking about again a little bit later on. This has been a story of the day. Geopolitical risk, but not just from Hezbollah and Israel, which may become a bigger risk, also from Libya shutting off the taps.
All right, well, you actually brought me to my first gainer today. That is ExxonMobil. Kind of tough to find gainers today that are notable, to be honest. ExxonMobil, among the best performers in the S&P 500. In fact, on a points basis, the best performer, up more than 2%. We did see energy stocks as a whole in the S&P rise as Ukraine said Russia launched drone and missile barrages at cities across the country, targeting energy infrastructure, causing blackouts. Shares of ExxonMobil today higher by more than 2.1%. And taking a look at what happened with Kava today, shares extending Friday's 20% post-earnings gain. Remember, last week, this was all about the company boosting its year sales outlook. Analysts did, in the wake of that report late Thursday, raise price targets for Kava since the company reported earnings on the 22nd. This is according to data compiled by Bloomberg. 10 analysts raised price targets by an average of 23%. Today, that stock moving higher by more than 3%. And I got a micro cap for you all to round out. It's a Rich Tech Robotics, excuse me. It's got a market cap of about $133 million. They make robots to help with food and beverage, food delivery, cleaning, busing, and more. Down more than 70% so far this year, but surging today close to 20%.
All right, it was not difficult to find decliners, so let's get to them now. I want to talk a little bit more about Nvidia. As I mentioned, not having a great start to the trading week, a very consequential trading week with Nvidia due to report earnings on Wednesday afternoon, falling about 2.3% today. No real catalyst. Of course, this is a stock that has moved about 155% higher year to date, so maybe some air coming out of the balloon before that event risk. I also wanted to talk about Pinduoduo. PDD Holdings. Shares falling the most since 2022. Of course, this is the owner of Temu, for example, and they warned basically that revenue growth, sales are probably going to slow from here. And it's a similar story to what we're seeing over here in the States, basically that weakening consumer. And then I also did want to highlight e.l.f. Beauty, because this has been one of the standouts in the stock market over the past couple years, but shares falling today, finishing down much lower, as you can see. That's after a Piper Sandler note came out that flagged that there was a slight deceleration in credit card data for this cosmetics company, and you can see shares definitely reflecting that.
Yeah, this like flies against my whole invest in your face thing. Anyway, that's a side note. I'm taking a look at yield. So they did actually manage to creep their way higher just a little bit in the front end tier yields, up by about 2 basis points. The why, though, I'm still trying to figure out, because if it's a safe haven bid like we're seeing in the dollar or with gold, you would have seen yields lower. So I wonder if we're just moving on different things, because that higher dollar, higher gold, that's a safe haven thing, but yields yet still moving a touch higher on that.
Okay, what do you guys think of real estate as a safe haven?
Okay, I'm super risk averse, guys. Like, I'm like gold bars under my bed, like put the soup cans, like have a go pack, that kind of thing.
Might be an inflation hedge depending on how, good of a real estate investor you are.
Okay, what about if you're Josh Kushner and Carly Kloss? There's a story out in the Wall Street Journal today. Katie and I can't stop talking about it because I learned today that she's not a huge fan of mid-century modern.
No, it doesn't really grab me.
Yeah.
No.
Yeah, she's one of the few,
You don't
I
like
guess.
mid-century modern? What do you like?
I like
good question.
I like houses that are sort of built out of stone and wood. I don't really like the look of this wave house, which is what Tim is talking about. The Wall Street Journal describes it as iconic, and I guess some people could see it that way.
There it is. It's on the TV right there.
Beautiful. I mean, it looks like the Sydney Opera House. That's cool.
Yeah.
It was built in the 50s. But look at that conversation pit. It kind of gives me the heebie-jeebies.
$29.5 million, down from the $49.5 million that it was listed for back in June of 2023. So it sounds like they got a deal.
There aren't many of these mansions that are attractive and cozy. I have to say that one looks attractive and cozy to me. I wouldn't say no.
Vani, I'm with you. I wouldn't say no
Right?
either.
Okay, wait, hold on a second.
It's in Malibu.
Katie,
also.
okay, if you don't like the structure, though, like, do you not like Eames chairs? Like, is this a mid-century modern, like, anti-all things, or just the architecture?
Yeah, no, I'm not a huge fan of a lot of the furniture. My husband and I do compromise, because he likes mid-century modern. I like a lot of gold and brass and, like, heavy jewel tone furniture, that sort of vibe. So, we find our way along. But, yeah, not a huge fan of the Eames chair.
Okay.
You have to have a few rooms to actually decorate, right? So I don't have that problem yet.
No, it's true, but they're just so comfy. All right, the story that I just absolutely love. Okay, imagine this, like you get an email from your boss, just hey, what do you think of the story? And then your firm gets fined $63,000. Like,
yes.
What would that be like? So apparently, over in Australia, Australians can legally ignore unreasonable after-hour work calls. So under this new law that just went into effect today, any non-essential business outside of work hours, and the company can be fined $63,000.
But how do you know if it's non-essential until you pick up the call, right?
Absolutely no idea. Guys, what do you think?
I don't know. I mean, I'm curious to see whether this is actually enforced. For example, I could see workers, I don't know, maybe getting pinged. Maybe it wouldn't be great for your reputation at work if, you have your firm written up for sending you an email at 8 p.m.
Listen to what the Prime Minister said to the Australian Broadcasting Corp, ABC. Just as people don't get paid 24 hours a day, they don't have to work for 24 hours a day. He actually added that he expects the changes to boost productivity. It kind of shows the difference between the way that people think about work in different countries.
I mean, they do things differently in Australia. They are in a different time zone as well, and we all know that the US time zone is the one that counts, so maybe they have to work at odd hours, right?
Maybe that's the problem. Okay, but here's my question with that. If you're not paid on an hourly basis, how do you judge whether or not you are paid to work 24/7? Like, if you're paid $1 million, I'm like, dude, pick up your email, whatever. But if you're paid $10 an hour, it's like, no, then you should definitely have a set time. So how do you judge that?
It's a fair point, and it's worth noting that you do have local business groups that have expressed concerns about the new laws. For example, the CEO of the Australian Chamber of Commerce and Industry said that these changes are a, quote, thought bubble, and that the business wasn't actually consulted on them. So there's the other side.
I was telling Alex earlier, if you work for 10 years in Australia, you get a pretty mandatory sabbatical of a year.
That sounds
everybody.
This is great.
Yeah. Awesome.
Sounds great.
Yeah.
You're in the wrong place, guys.
Yeah,
Wrong place.
I know. We really are.
You need to find Bluey
on work
somewhere
islands
else.
at the
Yes,
email
work
factory. Anyway.
Yeah, the land of Bluey. Maybe that's why it takes so long to get new seasons of Bluey.
Is that it? You guys don't know what we're talking about, but Bluey is like an amazing cartoon for kids that's good for kids and parents.
I was lost.
And you should go ahead and watch it on your own because it's awesome.
Yeah,
But
Bluey has wide appeal. All right, guys, I'm not going to go watch Bluey right now. We got more to do on radio. You all have more to do on TV, but don't worry. We are going to be back same time, same place tomorrow for more of the Closing Bell. That is going to do it for our cross-platform coverage. You guys have a great rest of your day. We're going to head on over and talk Nvidia a little bit. This is Bloomberg.
All right, more coming up. This is only the first day of the week with a lot coming up over the next few days, particularly Nvidia earnings. We're going to take a look at that, plus break down Nordstrom's also coming out tomorrow, plus the flows. What are robots and corporates doing? They should be buying. We'll break that down. This is The Close on Bloomberg. Welcome back to The Close. I'm Alex Steele.
And I'm Bonnie Quinn.
Let's take a look at where markets closed out the day on this Monday. So the S&P closed down by about 0.3%. There were the have and the have-nots. The have-nots were definitely tech, particularly the semis. Now the haves were the energy index. That was up by over 1%. Oil also getting a pretty powerful rally, up by over 3%. You got some geopolitical risk and some Libyan production haltage that actually wound up moving the commodity market and then is transporting itself into the equity index. All right, two things that I found really interesting. One, you saw selling in the bond market, but you saw buying when it comes to the dollar and buying when it comes to gold. Gold hitting yet another record, up 0.2%. Bloomberg Dollar Index up against most G10 currencies as well. What is that telling us? Is that a safe haven bid? And if not, why did yields not participate? We'll try and understand that throughout the next hour as well. Bonnie?
Well, it was one for all and all for one today with the SOX. The semiconductor index down 2.5%. Broadcom was the worst performer, down about 4% in the day. So we'll have to see if that all changes Wednesday. It's been a volatile few weeks really for the semis, but up to then it had been, up to the right and onward. One of the performers that did well today, one of the stocks in the green, Kroger, it's finally getting its day in court with Albertsons. They're trying to work out this potential merger. The FTC obviously doesn't want it because it says in several thousand markets in the United States, they're really the only two rivals. So this argument that they need to combine in order to compete with Amazon and Walmart is bogus. That's according to the FTC. Now, they did put together a package. They're trying to offload 600 grocery stores to C&C in order to help their argument and persuade the FTC. But actually, Bloomberg Intelligence Jen Rhee says that the FTC may win this time. They may not be able to complete the merger. That's not what the market thinks today. The market is quite happy to send that stock up 1.6%. And I also chose gold. Remember, a record is 25.31 hit just last week, 25.31.75, I should say. We're really very much not far off that. So it is really interesting to watch how gold is trading, even as we're perceived to be maybe not in as much danger economically as we had thought. So our top story for this hour is earnings. Nvidia earnings reporting Wednesday, 4:20. Be here. It's shaping up to be a market event. Citi says the options market is pricing in a 10% move for Nvidia either way, implying a more than 0.6% move for the broader S&P off of these earnings. And the stakes obviously are high, with the chip index still 13% below its July peak. Plus, as a bonus, we get numbers from more retail names, from Nordstrom's to Victoria's Secrets to the dollar stores, of course. The consumer discretionary sector looking at 14% earnings growth so far this quarter. So not too bad, Alex.
All right. Well, investors are on alert this week for an all-time high with all these catalysts going on. Goldman's Scott Rebner expects FOMO to increase as a result after robots and corporates rush in. Here to talk about the catalyst ahead is Bloomberg's Natalia Kniazhevich. Natalia, what does that mean, robots and corporates? Why the FOMO?
Right. So we know that during this last sell-off, systematic funds, which include commodity trading advisors, volatility control funds, basically robots that follow the trend whenever the market, whichever the market goes, the direction, so they adjust their positioning. So now they are in a buying mode. And Scott is saying that as of now, we see the so-called green sweep, which means that those systematic funds, CTAs, they will be buying no matter which direction the market goes. And on top of that, we also see that demand for corporate buybacks is really strong. For example, Goldman Sachs buyback desk said that last week, week was the strongest in 2024 when it comes to demand for buybacks from corporates, and it was 2 times higher versus the same period in 2023.
Natalia, what are the biggest drivers from the flows perspective? Why now?
Yeah, so it's all together. It's seasonality, and it's also the most recent sell-off also added more power. So we know that those systematic funds, they sold pretty aggressively. Now they are buying back. So I mentioned CTA funds. There are also 2 main strategies, such as volatility control funds and so-called risk parity. So when volatility drops, which is happening right now, this is an indicator for them to buy stocks. And on top of that, as we mentioned, seasonally, corporate buybacks, August and September is a really good, favorable season for that. And it's going to last. Scott is also saying, keep an eye, because corporate buybacks will be strong until September 13. This is when this blackout window starts, so we will see less buying. So he is tactically bullish until the middle of September. So this buying is pretty strong until
because
then.
What happens in the middle of September?
Yeah, so less buying from corporates, and then seasonality, because he tracks data going back to like 1928. And there is a huge spreadsheet, basically, he tracks that shows returns for the S&P 500 for every month. And historically, September is not a good month for the S&P 500.
Also, I guess that before you leave, just the volatility controlled funds, I think it's interesting too, because that's basically if volatility moves up and it moves up quickly or goes down quickly, they have to quickly change how they're allocated to protect how they're exposed to volatility. Is it the same on the upside and the downside?
Almost, but not the exact same. They tend to sell quickly, but when it comes to buying back, it can take more time. And it also, they track realized volatility, so they need to see volatility at this low level for quite some time before they start like buying back more aggressively.
So important to get those fun reads. Thank you so much, Natalia. Really appreciate it. Bloomberg's Natalia Kniazhevich joining us. So the S&P closed down slightly today. The bond market trade a little bit heavy, yields backing up just a touch. But there are some big catalysts ahead of this week, like Nvidia and July's PCE, the Fed's preferred inflation gauge. Couple those with those robots and corporates that Natalia was just talking about. And we wanted to just check in on where the flows and positioning sit. Christopher Caine is quantitative equity strategist over at Bloomberg Intelligence. How are we set up? What are you noticing, Chris?
So the one thing that I'm really kind of looking at here, right, is the correlation between stocks and bonds. It's something that I don't see that many people speak about, and I think is really interesting right now. So when you look at the correlation between long duration Treasury bonds and S&P 500, right, prices versus price is very high right now. So about positive 0.78. It's actually one of the highest correlations on a rolling 12-month basis that we've seen in 50 years. If you transform that into a percentile, it's a 98th percentile result over the last 50 years. So very positively correlated. But the one thing that we found is a coincident indicator, let's call it, with this stock bond correlation is just inflation. So when inflation is very high, what you tend to see is the stocks and bonds move together. When inflation goes low, they tend to decouple a little bit. If you look at the median CPI inflation over the last 50 years, it's been about 3% in the U.S. We just crossed below that 3% threshold. To me, that says that the stock bond correlation should come down. When you break up the CPI into 2 buckets, again, over the last 50 years, you see an average correlation of 0.4 when inflation is above 3 and about minus 0.2 when it's below 3. And again, right now it's at positive 0.78. So very elevated, but with inflation coming down, we think it should come down a lot.
Just to clarify, when you say correlation, do you mean when there's buying in equities, there's buying in bonds, or when there's buying in equities, there's selling in bonds? That's kind of become confused over the last few years.
Yeah, right. Sometimes the correlation between stocks and bonds gets confusing because sometimes people do it the price of stocks and then yields, which move the opposite of bonds.
Exactly.
But what I'm talking about is the price of bonds and the price of stocks. Mm-hmm. Like you said, buying in stocks and bonds, So
that's counterintuitive then.
Well, I think the intuition here is more like when inflation's really high, basically it's bad for both, right? It's mathematically bad for bonds. Obviously, that should mean rates go up, the Fed gets hawkish, et cetera. And it's bad for stocks as well. When inflation goes lower or is decreasing, it's not as clear of a picture. So I think that's why you see that correlation really decrease.
What stuck out to you over the last few weeks in terms of when we sold off? And then how do you think that reaction function will be going forward?
So the one big thing that really stood out, so what was it, like 3 weeks ago, right? We had that big volatility
Seems like
event.
a year ago, but sure.
It does. It does seem like a long time ago, but it was, I looked it up, it was August 5th.
Oh my God.
I know, right? But, we had that big decline, a big spike in equity volatility. The VIX hit a 60 intraday. It closed at 38, very high levels. The one thing we looked at is the relationship between equity volatility and corporate bond spreads. And that relationship is what you would think, right? When equity volatility goes up, usually that means the stock market goes down. That would be coupled with wider corporate bond spreads, which is totally, logical. But what we saw on August 5th was really a huge outlier where we had very high equity volatility and very muted corporate bond spreads. They barely moved. They're still, rather low historically. When you make a scatter plot of those two things, it was a huge outlier. Our takeaway from that was, that the sell-off 3 weeks ago was more technical in nature. It wasn't because of a quote-unquote real economic problem with the assumption that would, show up in the bond market. So we thought potentially that was, maybe a good opportunity to put some cash to work. It has seemed to prove out to be.
Is this also all the Mag 7's fault? Because if there's a sell-off in 2 or 3 stocks, it looks like there's a big sell-off in equities?
Of course, they have an outsized, influence just because of the market cap weighting. Almost all of the, equity indices that people follow, like the S&P 500, Bloomberg 500, market cap weighted. That being said, I will say earnings season has been very good. The rest of the stocks have basically doubled their earnings expectations over the quarter. We call them the other 493. So the rally is broadening out. The fundamentals are very strong. So I can't see us moving into a scenario where it's not just the Mag 7 that's carrying us; it's the rest of them catching up.
Chris, thank you so much. Always a pleasure. That is Chris Caine of Bloomberg Intelligence. Coming up, the top 3, where we focus in on the top 3 movers and shakers at the center of the day's biggest stories. That's next. This is The Close on Bloomberg.
Time now for the top 3, where we name drop the people driving some of the day's most talked about stories. First up, Fortress Investment Group has now appointed the former chief executive officer of P.F. Chang's to lead Red Lobster when it is acquired by its lenders out of Chapter 11. Damola Adam Oldkun will become Red Lobster's CEO after a Florida bankruptcy judge approves the restaurant's proposed plans for exiting Chapter 11 under new ownership. Can he get it done?
I love these stories. So first of all, you have Brian Niccol being taken from Chipotle to Starbucks, and now you have somebody who has a lot of experience at P.F. Chang going to Red Lobster. I mean, let's hope he can make a go of it, right? He definitely comes from the sort of private equity end of things, and he knows how to
sort of turn it around.
Lean.
Yeah, exactly. Make it leaner, maybe, but make it also something that you want to go to that still has its brand, right?
Yeah.
And maybe like unlimited shrimp isn't very profitable. Maybe that's not a good idea.
Exactly.
All right, what are you watching?
Exactly. Well, remember Once Upon a Time in Shaolin? That should ring a bell. It was the Wu-Tang Clan album. It was their 7th studio album. There was 1 copy made, and guess who bought it? It was Martin Shkreli. Well, he was prohibited from possessing it. He was also told to forfeit all of his assets. And so this album, this one double CD album, was bought twice by a group. They paid in total $4.75 million. They can't get their hands on it. And it turns out Shkreli did actually do a YouTube where he broadcast some of this when he came out from prison in 2024. That's how they knew he still had it. Now they're looking for it. And I just can't believe this story. I can't believe it's still in the news. But the question is, did he ever make copies? Did he distribute copies? Where is the double album now? Why can't we get our hands on it? What is on this album, Alex?
Wait a second. So he bought it, he had it, it was sold to these group of investors, and then he wouldn't give it over? Is this what I'm understanding?
Exactly.
Here?
It was sold twice, in fact. He paid $2 million. They ended up paying $4.75, so good investment, Martin Shkreli. But he didn't hand it over. No one knows where it was. At one point, it may have been in a Moroccan vault. I mean, he was in prison for some of this time, but when he got out, he did have possession of it.
Right, and then he broadcasts it, and then it's like, well, I'm just going to record that. I don't need the record.
And I didn't know it was being broadcast.
Or else, she would have been into that. All right. Here's a CEO you might not know, but here's a CEO who's definitely under a headache today. So apparently Qantas Airways accidentally sold return first-class airfares between the U.S. and Australia for as much as an 85% discount of the usual premium cabin fare. Passengers snapped up 300 of the tickets within 8 hours. That's according to Qantas. The lucky flyers got the tickets for roughly $3,300 versus $13,000 to $20,000. Airline said it's rebooking the customers into business class. I mean, that's still fine.
But that's
saving the 55%.
problem I have with this. Oh, you booked a ticket. Why are you getting rebooked into business class?
Dude, I would go rebook and book business class. Like first or business, I'm good either way.
If I bought my first class ticket, it's not my fault that Qantas messed up.
Well, yes, but isn't it nice that you still get business? They're not like
I paid for first class.
No, she wants the first class.
Even if I did, I mean, I'm not going to have the food. I just want to,
Although you're not going to have the food in like a 16-hour trip.
No, I mean, I don't
from LA.
need the trimmings because honestly, business class is fine. But if I booked and paid for it, or compensate me, give me a second flight.
Anyway, $3,300 for business class to Australia. I'll take it. All right, much more coming up. We're going to look ahead to Nordstrom's and Nvidia. This is the close on Bloomberg. Apple stock up almost 10% since its August low. Its next catalyst could be right around the corner. Reportedly, Apple has sent out invitations for a September 9th product launch. It's called It's Glow Time. Joining us now is Bloomberg's Mark Gurman. Hey, Mark, what are we going to expect? What's up with the name?
Yeah, so Glow Time, and if you look at the graphic, that's actually in reference to the new user interface for Siri that's coming to the new iPhones this year, as well as last year's iPhones, as part of Apple Intelligence. You see it on screen right now. When you press the side of the phone or activate Siri, you sort of get that color effect on the rim or the bezel around the iPhone. Same as on the iPad, same as on the CarPlay, and those colors are through the Apple Intelligence user interface. So clearly a reference to that being a key focal point of these new devices.
Mark, what can we anticipate in terms of actual functionality and other products?
So the three things that I'm expecting on the 9th are the iPhone 16, which is 4 models, new AirPods, which is 2 new versions, as well as new Apple Watches, which is 3 new versions. So it's going to be a fairly jam-packed showcase on that Monday. The iPhones, not major overhauls, but you're going to see new processors. You're going to see a new button, which is a dedicated shutter button for taking pictures. And on the Pro models, you're going to see slightly bigger displays. The AirPods, the non-Pro ones, are being revamped. So you're going to have a new entry-level AirPods for the first time in 5 years, as well as new mid-tier AirPods for the first time in 3 years. Those are going to have some Pro features. The mid-tier ones specifically are going to have a similar charging case with sound as the AirPods Pro, as well as active noise cancellation. And then the third thing are the new Apple Watches. You're going to see a new low-end Apple Watch with a move to plastic for the first time, which should make it a little bit more kid-friendly. They've been pushing that idea, using watches instead of phones on children, in schools particularly.
Yeah.
You're going to see a new mid-tier watch, that's their flagship, the Series 10, thinner with bigger screens. And then you're going to see an upgraded Apple Watch Ultra 3 with some of the new health features also coming to the Series 10.
Hey, Mark, I know I have you on the spot right now, but this headline just crossing that Apple is replacing Luca Maestri as its CFO. Instead, Kevin Parekh will be taking that role as CFO. Do you have any reaction to that? The stock is down by about 1% post-market.
Not surprised. We've been hinting at this for some time that Luca is being replaced with Kevin Parekh. We've reported several times that that's happening. Luca had been in the role for nearly a decade now. Kevin had been the heir apparent, and it's become obvious in recent months, and we've been flicking at that in our articles recently.
Wonderful stuff, always with the breaking news. Mark Gurman, thank you so much. That is Bloomberg's Mark Gurman there. Do follow his stories on the Bloomberg. Well, as we know, Nvidia earnings Wednesday could move that stock more than 9% in either direction, and therefore overall markets. Nara Logics CEO Jana Eggers is with us now. And Jana, it's interesting because you've been in this space for many years, a lot longer than most, let's say. And we all know that AI is disrupting, but it's been around for forever as well. It has been disrupting over time. How many quarters for can Nvidia outperform such that, you know, it makes us believe in AI is taking over all of our jobs?
So I think that's going to be the question is, can the AI that's happening right now outlast what's needed next. And what's needed next is more some things that Apple brought out last time I was here actually and talking, is that integrated AI where it's looking at your calendar and your email and maybe some voice messages that you have and bringing that all together, much like our brains do. Our brains bring our eyes and our ears and our nose together to form a complete picture. And so that's going to be the question is, can this relatively simple AI that's actually happening right now continue to fuel somebody like Nvidia right now until we get to that next stage? And will they be able to then catch up with chips too?
I would love if something made my brain work better sometimes. So then there's two things, I guess. One is like the hyperscalers and the data center and the large language models and all that stuff, right? Then the other is how the consumer, someone like me, is going to use the product and pay a little bit more to get that added benefit. Which one do you think is going to be the short-term driver?
I think the large language models and all are going to be that short-term driver.
Okay.
So when you think about it, there's some interesting research out of MIT's neuroscience lab, Eve Fedorenko, and what they've shown is our brain, the language model part of our brain, is actually separate from the common sense and the logic part of the brain. And so what you're looking for is that logic part of the brain, and what's going to help you really make better decisions faster without as much tax on your brain. So that's going to be the question is, so can LLMs just sit there and feed some of that for now and then get to the more complex task of common sense and reasoning?
So can you give us an estimation for when we get clarity on any of this? How many years are we from that?
It depends on how distracted we get from things like image generation and LLM. So
probably very.
I think we are very distracted by them, and that's where large amounts of money is going right now. And if we put more of that money into some new and foundational research, Jeff Hinton, for example, said a few years ago the biggest advancement in AI that's going to come is if you throw out, somebody that throws out what I do and start something new. And I think that's really true, is let's not get distracted by this. Let's use it and leverage it and be excited about it. But let's not get distracted by it.
So the two questions I feel like is going to be for NVIDIA is one, are the hyperscalers going to pull back? And what is NVIDIA hearing about that? And what are the capacity constraints when it comes to its Blackwell chip? What are the questions are those the right questions to be asking on Wednesday? Or what are the questions you would be asking?
I don't think the hyperscalers are going to pull back.
Okay.
Because I think there's still enough room.
We haven't
there.
heard anything of that nature when it comes to their own earnings.
I don't think that at all. I think the questions I'd be asking is a little more on the power side, like where are we going to get crunched on that power side with the data centers, because you're starting to see some creaking in that, and the power infrastructure isn't quite there yet. And so when are we going to hit those limits, which is not my area of expertise, I have to say. So I'm sure y'all have access.
Well, no, it is interesting. I mean, they talk about natural gas fueling these power stations and where are we going to get the natural gas from? And then you see other reports suggesting that, I think there's a lot of lack of clarity around that space as well.
So that's one question that I would have. And then the second one is, how are they going to package with other things? Because I think even now with LLMs, we still need it to marry with other things. Amazon just announced $260 million in savings. But if you look at that, compared to their spend, that's like 0.04% of their overall expenses spent. I mean, it's nothing. And so that's, 0.04% of a job. Right? That's really nothing. And most of us can pick that up or, hey, great, that allows me to do something extra, right? And so I think that understanding how those pieces fit into other jobs is where it's going to be like, what can NVIDIA do to link those together?
Is there any kind of scenario where this all falls apart and it really just doesn't become all that profitable for anybody and maybe NVIDIA loses some valuation?
That would definitely be a market event.
Well, sure. If you follow your logic.
Yeah, I don't think it will all fall apart. Yeah. I mean, look, I've been doing this for 30 years. I'm vintage AI. And I think that we have enough behind us. There's enough cool stuff going on. I mean, I'm not trying to play down what Amazon said. Sure. I think it's great. I have engineers that would love some of these foundational models to be updated, more efficiently. So I don't think that's all going to fall apart. There's actually value there, but it's not the billions and billions of values immediately that people have been talking about.
Well, it kind of reminds me of the crypto infrastructure, right? Because we've been talking about crypto and blockchain for forever, and it's really only sort of now that it's becoming useful to people in some ways.
Yeah, and that goes to the point of sort of your point about the energy and kind of are there restrictions that we've seen for data centers for crypto and then for AI that will sort of stem that growth in essence. Before we let you go, the other conversation that we've been hearing is Nvidia just going to kind of flatten out, right? They're going to deliver super solid numbers, but the stock's going to do a whole lot of nothing, and that the whole kind of sector is a little bit of a malaise. Is that legit? What do you think?
I think it could.
Okay.
But my caution on that would be that I see them doing a lot of this integration that I was talking about. So I was out at HPE's Discover event, and they had a big announcement there with NVIDIA. So the more that they do that and work with the ecosystem of how much, hey, how do I plug in here rather than just being alone themselves, which they're not doing at all, I think that they'll, there may be a little bit of flattening compared to where they were before, but I think there's just still so much opportunity. That's not an area that I'd worry about.
All right, Jana, thanks a lot. Jana Eggers joining us, Nara Logics, CEO, on what to really ask about when we see NVIDIA earnings coming out on Wednesday. All right, let's take a look now on where markets have closed for the day. You got the S&P down by about 0.3%. You got the Russell now a little flat. It was up throughout the majority of the session, but it rolled over right into the close. Where you did wind up putting money is in oil, the dollar, and gold. Within the S&P index, you saw energy outperform, up by over 1%, while consumer staples and utilities were also up by about 0.7%. This is the close on Bloomberg. It's another big earnings week. Yeah, we got Nvidia, but there is a ton of retail earnings out as well. You got all eyes on consumer sentiment and margins with all those retail companies reporting earnings. You got from Nordstrom to Best Buy and Dollar General. Lululemon also reports, and Telsey Advisory Group analyst Dana Telsey cutting her price target on Lululemon to $360 from $470 as she moderates her sales, margin, and earnings estimate for the back half of the year. Dana Telsey joins us now. Lulu's the 29th, right?
Yes, it is Thursday after the close. You've got Lulu, Gap, and Ulta all after the close on Thursday. And we have a ton at the beginning of the day with everyone.
Oh, actually, Dana, hang on one second. Your mic is off. We're going to turn it on for one moment. So Lululemon is reporting on Thursday. There's a lot more coming out. We got the dollar stores. You got Gap. You got Ulta that day as well. And then also Nordstrom, Isvani, is going to be tomorrow.
What's interesting is that you have all of the spectrum of the consumer, right? So everything from Nordstrom all the way down to Ulta. Not that Ulta is all the way down, but there, there's and Lululemon. I mean, that's a very discretionary purchase for a lot of people.
Oh yeah, I'm not paying $100 for a pair of leggings. All right, Dana is back with us now. Her mic is working. Okay, so Lululemon in particular, let's just start there. Why the downgrade?
Well, lowered the price target, given the fact that we do expect earnings in the back half of the year to be moderated. The stock has come down, almost anticipating this weakness, so that risk reward is there. I think you're going to hear a lot about the international business, what's happening with China, given that it's been a big growth vehicle for them. They did eliminate the breeze-through, pulled it off the shelf, the new fabric. But keep in mind, as they have said, the back half of 2024, there's going to be an acceleration of new product innovation. And that's where the demand is going to be going forward.
Do you see any kind of consolidation in this space? Because there's a certain part of town where I walk down and I just can't stop passing these stores that are trying to sell me sweatpants and leggings. Sweaty Betty, Lululemon, Aloe. What's going to happen?
I think overall, when you look at all of them, they each have a different profile in a way. You look at Aloe, and I think of it as fashionable. I think of Sweaty Betty, more affordable. I think of Lulu as more technical. But what they all need to do is product innovation to be able to drive demand and capture that consumer dollar. Let's see what happens as these numbers come out. The other thing that's going to come out on Thursday, Gap will report, and don't forget, they own Athleta.
Yeah. Well, I was going to say, I love me Gap workout clothes. Not even Athleta, but like the regular old boring Gap workout clothes, those are the ones I love the best. What do you think we're going to see at Gap?
I think you have an improvement in the Gap brand with denim. I think denim has increased as a percentage of their sales. Wide leg denim is a new trend. And they've got lots of new marketing and advertising to give people something to remember. So let's see if they give us earnings to remember.
Are people still buying workout clothes? They presumably went on a rampage during the pandemic.
I think they still are. When you think about the overall apparel world, look at what's happened with work environments. For those people who do go to work, even if it's only 2 to 3 days a week, what's happening? They're wearing more casual clothes to work. Look at everyone's shoes these days. They're certainly more comfortable than just the heels. And there's a new brand out there, the former founder of Spanx. She put out sneakers with high heels called Sneaks.
Yes.
Wait, what?
Sneaks.
I've seen these.
Check it
Okay,
out.
I'm doing it. I'm doing it.
SNE.
A little reluctant.
Okay,
Along
I'm
with those
definitely checking that
PVC
out.
Wellington boots that you put over your regular boots that are coming for the winter. I'm curious to see how they'll go down as well.
I can't think about winter now when it's going to be 90 degrees on Wednesday.
It's too much. It's too much. All right, so let's see. What else we got this week? We also have dollar stores
We have the
coming
dollar
out.
stores coming out. Don't forget, it's been a case of the haves and the have-nots. Walmart, Target, TJX, and Ross stores have been the haves. We've had weakness coming out of Macy's, Dillard's, Urban Outfitters. You've got not only the dollar stores, but Burlington's coming out also on Thursday. We'll see what they have to say. And you think of where there's innovation and momentum. Let's watch Abercrombie and Birkenstock. Intentional spending at full price. I think that's what you're going to see.
Well, actually, it's funny you say that because the only thing I'll pay full price for is Birkenstocks and Bionics because they never go on sale, and I got to have the orthopedics.
And now it's about closed-toed Birkenstocks also. It's 25% of their sales, a very good AUR, and moving higher as a percentage of the business.
How much is it about innovation and how much is it about getting the TikTok crowd or that one influencer?
It's all of it. If you're not going to get the TikTok crowd if you don't have product that's innovative, you're going to get the TikTok crowd if it's something that's new and exciting. And what does that TikTok crowd do? It expands the audience, not just to the TikTok generation, but to generations beyond that.
Because when you talk about Ulta, I'm, amazed at how many new makeup brands there are constantly now. It used to be, it was kind of a big deal if you saw a new makeup brand and, the Old Faithful were the Old Faithful. Now it's like there's so many of them in both of the stores, Sephora and Ulta.
Yes, this year, for example, Ulta's going to be introducing 25 new makeup brands, and the key is who gets the exclusives. So this week we have the US Open tennis matches, and Serena Williams, who has her makeup line exclusively at Ulta, WYN, is going to be expanding that makeup line. So the excitement of makeup, it's not just Zoom makeup anymore. Keep in mind those items that everyone's buying on TikTok, they want to look good in person in real life and on the screen.
Okay, I'm totally obsessed with these shoes right now. The sneaks.
The closed-toes Birkenstocks?
No, the high-heeled sneakers. Oh my gosh, this is going to be so sad for me when I have to buy them.
But there were platform sneakers a while back, right?
Yeah,
So
but these are like
iteration.
stilettos. They're okay, I digress. Nordstrom tomorrow. What are you
Nordstrom's
expecting?
coming out tomorrow after the close. Keep in mind you had the anniversary sale that happened, where more of the days of the anniversary sale pulled into the second quarter, so it should be a benefit for them. But it still is about the rack. The rack is their growth vehicle. We know that off-price and rack brings people to their full-line stores. So to me, it's about the rack. And obviously, there's new initiatives, better brands that are going in the rack. We need to see if the designer business is still challenged at Nordstrom. And let's see what happens with credit card revenues tomorrow. From what we've seen from other department store retailers, it's a challenging department store environment with orders being very cautious that they're placing with vendors.
So what do you do in a situation like that? Because we have examples of stores that are doing extraordinarily well. Abercrombie and Fitch, for example, really turning it around. Gap, completely turning it around from where it was a few years ago. And yet the department stores can't do it, but they're just an amalgamation of lots of different stores. So why not? Does someone need to get fired?
I don't think it's necessarily getting fired. It's basically innovating and changing the look. You need to reinvest in what the store looks like. You need to reinvest in the product and reinvest in marketing to attract new customers, because everyone has a lot of choice these days. And when you think of what makes a brand or a retailer successful, what are you doing that's innovative to drive a successful concept with repeat customers? How you are on seamless and speed in order to execute better? And what the data is informing management of in order to fulfill their path of progress and growth going forward. So there's a lot changing in our world, and we're going to have more about that end of the week.
What are people going to buy during Christmas? Because this is when the retailers have gotten it right. They're like on the cargo ships, waiting to get into their inventory. What's going to be the hot sell?
I think you're still going to have Birkenstock be a hot seller for Christmas. I think you're going to have some newness in some of the outerwear that's out there. And could we see a little bit of a return to electronics for the holiday season?
Really?
Let's watch that.
Well, we hear that from Best Buy. Isn't Best Buy later this week too?
That's one of the things you could hear about.
Interesting.
Skinny jeans.
No, they're dead.
Making a comeback?
No, they're dead.
It's still wide leg,
It's
wide leg and loose.
No, I think you guys don't have your full information.
Okay, wide-legged loose. Well,
wait, why are skinny jeans back?
Bella Hadid was photographed wearing them, and I think Kendall Jenner as well. I think there might be a skinny jean coming.
As long as there's newness, that means there's new tops and new shoes, and hello retail sales.
I need that for there. One more quick question, Dana, because I love having you here. In general, we know we're seeing the bifurcated consumer. We know we're in that K-shaped consumer recovery, right? So what kind of companies handle their margins well and not discount too much where they sacrifice their margins, but they still keep that top line and they still keep the amount of people coming into their stores? How do you find that magic sauce?
One of the things that's happened is everyone's inventory levels are still lean. But it's still,
okay.
Even if you are able to manage that, you still need a product that sells. Birkenstock's part of that product initiative and innovation this year that's new.
How much did the Red Sea troubles and the Strait of Hormuz troubles take up your time the last couple of months? Are you concerned at all about them anymore?
Yes, I'm worried about freight expenses and the increase in freight expenses as we go into the second half of the year. A lot of these companies have annual agreements where they up the ante in terms of what the contracts could look like. A lot of them get renewed in the spring, so we're watching for what impact on 2025 that could have.
Favorite company right now?
Like the Birkenstock story a lot.
Really likes the Birken. You're doubling down on that
fan.
one. Okay.
I like TJX. I think the off-pricers, TJ Ross and Burlington, are all going to be winners that capture traffic.
If Kamala Harris is elected, do any of these brands need to be worried about price gouging, any of these department stores?
I'm not hearing about that right now. I mean, I think overall, typically what we've seen, because we look back to 1972 in elections, Democrats and incumbents typically do best for consumer spending.
All right, Dana, we cannot wait to see the results of this week's results with you. Dana Telsey is Telsey Group CEO, and she joined us there in studio with some thoughts ahead of many of those earnings this week. Still ahead, we're going to look at what investors need to watch for tomorrow and throughout the rest of this week, so stay tuned. This is Bloomberg.
Monday in the books, but there's a lot happening tomorrow. Here is what we are watching. So after the market, we get Nordstrom, Sentinel One, and PVH, which of course owns Ralph Lauren. So obviously interested in all of the kind of read-through we'll get from retail, Lonnie.
I cannot wait to see what it says about the consumer. You know what else we get that'll tell us about the consumer? The Conference Board consumer confidence data. And we have had mixed data on the consumer and their confidence. They have been a little worried about the labor market, but maybe those worries are going to get assuaged, and we'll see that in these new data.
Yep, and we're definitely going to get the present situation and the expectations. And the expectations, I wonder how the election will or won't sort of affect that. And finally, the NFL is meeting to discuss private equity firms buying into teams.
This is fascinating because you know Roger Goodell wouldn't have allowed the vote to happen unless he knew it was going to pass, but the NFL is one of the last sports to allow PE in. So apparently PE can own up to 30% of a basketball team, which I didn't know. But it really helps, it will help if you're building a stadium, which the Buffalo Bills are, also the Cleveland Browns, the Chicago Bears. I've been watching Hard Knocks, so
like knows your stuff.
That might be the reason why I know all of this. If you had asked me a few weeks ago, before I binged Hard Knocks, I wouldn't have known.
Hey, I'll take it, because I was like, yeah, that's happening. All right, that wraps up for us on this Monday. Bonnie, thanks a lot. It's been a pleasure to have you here. Balance of Power with Kelly Lyons is up next. Have a great evening.